If the Chinese government crackdown is causing so much pain,
I guess I'm wondering, is there a limit to which the Chinese will...
It owes $300 billion in liabilities to various creditors.
Social media footage shows crowds protesting in front of the offices of the Chinese real estate developer Evergrande.
Too big to fail was a phrase used during the 2008 financial crisis for large companies so overextended that their collapse could cripple the global markets. Now, China is trying to make a too big company with too much debt that's already missed key payments and manage its failure. The company is a real estate giant called Evergrande.
While growing signs that China is worried Evergrande's debt crisis is undermining the property market.
Evergrande's massive debt problem has rippled out into global markets, with the S&P 500 seeing big swings.
Crash in the market, which is cooling rapidly, but it has vowed not to use the housing sector to stimulate growth. China's home sales slump widened last month, hitting the lowest point in more than a year. The credit ratings agency Moody's warns the property slowdown and Evergrande's credit troubles will hurt local governments. And
Evergrande borrowed a lot of money, what we call offshore in international financial markets, and it's probably not going to pay it back.
Now, offshore bondholders are saying that Evergrande has remained silent on its debt obligations, and that's worrying investors who fear that they could face huge losses when the 30 days grace period come to pass in a month's time.
The Chinese government has been cracking down on debt. Major real estate developers had been the recipient of these crackdowns. Alibaba is not an exception. Alibaba reached its peak price at almost $310 per share. Today, Alibaba trades at less than half of that, $143 a share. Alibaba is not just a global e-commerce company, it is a massive internet and technology company as well, with high growth prospects on cloud-based computing. China's Xi Jinping encouraged and implemented rules and regulations that promoted common prosperity amongst Chinese people. These rules and regulations directly affected Alibaba's operations. Thereby, as an effect, its stock price took a massive hit. The Chinese government pressured Alibaba to divest its media holdings, such as full stake at Mango Media Company, Alibaba's financial affiliate, and Group was planned to go public in 2020 but was blocked by the Chinese government. In December 2020, China's government started an investigation on the anti-monopoly practices of Alibaba. It was then concluded by the regulators that Alibaba broke the anti-monopoly law. This meant that Alibaba had hindered competition in online retails that affected consumer interest. Thereafter, the Goliath e-commerce company was hammered with $2.8 billion antitrust fine. This record fine was not just money, it was a message, a clear and solid message to the Goliath tech companies of China that they cannot be more powerful than the government. Xi Jinping is halting and avoiding companies to be more powerful than the government itself. Aside from cracking down on giant tech companies, the government is cracking down on debt as well. Reason that many real estate developers are defaulting on their credit payments. Recently, one of these companies is a giant developer called Evergrande. When the Evergrande crisis was brought to light, Alibaba's stock started to decline. I hope that you have noticed what is the common theme here. All the factors mentioned that affected Alibaba's stock price were all external factors. These factors are all about the government's rules and regulations, the Evergrande crisis, which is not connected in any way to Alibaba. To prove my point here, let me give you some numbers corroborating that Jack Ma has been indeed phenomenal in managing Alibaba's finances and overall operations. This company has a remarkable less than 1 year of debt, equivalent to the company's earnings. Alibaba is also very profitable with a net margin of at the very least 25% in the last 10 years. The company is also forecasted to reach a compound growth rate, or CAGR, of almost 19% in the next 5 years. As you see on this table, Alibaba's revenue together with its net income has been growing year on year. The comparison is that Alibaba is Asia's Amazon. Let's have a deeper overview on the breadth and width of Alibaba and Amazon's markets. Amazon's biggest market are the USA and Europe. In 2020, Europe's population was sitting at 448 million. It is important to note, though, that Europe's population is on a declining trend. The US population, on the other hand, was sitting at 330 million in 2020. Even if we combine Europe and USA's population, this is still not comparable to China's population, which is sitting at a mammoth figure of 1.4 billion in 2020. This is indeed a massive market for Alibaba. The company has also expanded in its neighboring countries in Asia to further grow and establish its footprint in the region. Alibaba Cloud plans to invest $1 billion across the Asia-Pacific region over the next 3 years. This is Alibaba's largest investment allocation in 2021. The investment is intended to support talents and startups across the region. Alibaba is also heavily invested on Vietnam's retail market to the tune of $400 million. Alibaba's most renowned brand outside of China is called Lazada, a Southeast Asian e-commerce platform in which Alibaba owns a majority stake. Alibaba also boasts a staggering 32% revenue growth in 2021. With the current market price of Alibaba sitting at $143 a share, it is, to my valuations, undervalued. But that is again just my valuation. I certainly recommend all of you who are watching to do your own due diligence, to make your own research and evaluate this company on your own terms. Remember, the stock price decline of Alibaba is not caused by any internal company financial problems, nor poor performance, neither management poor decisions. The stock price is dropping and has been dropping because people are scared, because people are spooked by the actions of China's Xi Jinping. Alibaba's moat is not affected. It is still the same. Alibaba's revenue was not affected. As a matter of fact, it is recorded to have achieved through-the-roof growth of 32% in 2021. The most stunning fact, when everything is said and done, is that Alibaba's stock price is dropping. As a matter of fact, it is almost close to my 10-cap valuation. And 10-cap valuation is the most conservative and safest valuation there is. Charlie Munger, the world's renowned partner of Warren Buffett at Berkshire Hathaway, recently bought shares of Alibaba worth $37 million through a company where he serves as the chairman, the Daily Journal Corporation. This $37 million is equivalent to 19% of the Daily Journal Corporation. Alibaba is Daily Journal's third biggest holding, next to Bank of America and Wells Fargo. In summary, Alibaba, at least to my valuation, is a value investment long term. But one question you must answer for yourself is, are you ready and emotionally equipped to manage the risks of the Chinese economy? The SEC just adopted a rule that will require US-listed Chinese companies to be audited by US tax authorities, as well as disclose Communist Party affiliations. This ruling stroked fear in some investors, which prompted some Chinese securities sell-off. Remember, the Chinese Communist Party by Xi Jinping does have the ultimate power over China, but China's Xi Jinping is also a capitalist. He is well informed that without capitalism, China cannot be a world power. Without liberalization of foreign businesses, foreign investments will cease to exist in China. And Xi Jinping's goal, at least it seems so far, is for China to be taken seriously by Western countries as a serious world power.
Thank you very much indeed. I hope that you enjoyed this video, and I hope that you gained value from my video and my channel as a whole. If you did, please share, like, and subscribe, and I certainly hope to see you on my next video.